Understanding the Stochastics Indicator. Stochastic oscillators are one of the most versatile and effective tools in technical analysis. This step-by-step guide aims to provide technical analysts and traders with a comprehensive understanding of how this indicator works, its applications, and how to harness its potential for better trading outcomes across multiple markets. Whether you're trading Forex, futures, or cryptocurrencies, mastering this indicator could empower you to make more informed decisions. The Stochastics Indicator, designed by George Lane in the 1950s, remains a cornerstone of modern technical analysis. This momentum oscillator measures the closing price relative to the price range over a defined period. It offers traders insights into whether an asset is overbought or oversold, signaling potential reversals or trend continuations. Understanding market momentum is crucial for traders who rely on precise entry and exit points. Stochastics simplifies this process by offering a structured view of price movements. Its ability to highlight potential reversals in any trading environment, be it trending or range-bound, makes it indispensable to technical analysts. In this video, we'll explore how the Stochastics Indicator can be applied to Forex, futures, and cryptocurrency markets. Central to the Stochastics Indicator are two key components, %K and %D lines. **%K line represents the raw stochastic value and is calculated as **%K equals sign, current close, lowest low, highest high, lowest low, X, 100. ***. This measures where the current price is within the recent high-low range. **%D line. A simple moving average, typically 3 periods, of the %K line, providing a smoother indicator for better interpretation. Together, %K and %D generate signals when they cross or enter specific predefined zones, for example, above 80 for overbought, below 20 for oversold. Visual representation of these lines on charts makes it easier for traders to pinpoint key moments to act. Beyond formulaic understanding, mastering these calculations helps traders develop a more intuitive grasp of price momentum and deceleration, fostering confidence in interpreting and acting on chart signals. Forex markets are known for their volatility, making momentum indicators like stochastics especially valuable. In currency trading, identifying overbought or oversold levels can help traders anticipate reversals or continuations for major pairs like EUR-USD or GBP-JPY. For instance, when the Stochastics Indicator shows a %K line crossing below %D in the overbought zone, it may signal a pending downward correction in price. Conversely, bullish momentum often begins when the %K rises above %D in the oversold zone. Alongside practical examples, analyzing Forex charts highlights how using stochastics in conjunction with support and resistance levels or Fibonacci retracements can enhance signal reliability. As currency pairs move with significant speed, traders can confidently spot high-probability trading setups. Futures markets, which include commodities, indices, and interest rates, provide another avenue for stochastics-based strategies. This section focuses on incorporating this indicator for futures contracts, such as crude oil or S&P 500 E-minis. Take gold futures as an example. If prices are trading near long-established resistance and the stochastics crosses downward near overbought conditions, traders may anticipate a shift downward. On the other hand, crossovers within the oversold region near potential support levels could present a buying opportunity. Trade setups within futures markets often benefit from layering stochastics over time frame specific charts. Examining both short-term, for example 5-minute, and long-term, for example 1-hour charts, can help fine-tune optimal entry or exit points. Proactively identifying these opportunities minimizes ambiguity and provides a clearer picture to technical analysts. The cryptocurrency market is remarkably volatile, making technical analysis a critical skill for successful trading. Stochastics offers traders a method to interpret overbought or oversold conditions in high-momentum cryptocurrencies like Bitcoin, Ethereum, and other altcoins. For example, if Bitcoin's stochastics hovers above the overbought range, 80, for extended periods, yet fails to break a major resistance level, it could signal a potential sell-off. Similarly, Ethereum trading at an oversold level below 20, followed by a bullish crossover, may trigger a rebound toward critical resistance. This section demonstrates practical chart examples with common cryptocurrencies, showcasing how to use the Stochastics Indicator in conjunction with market patterns, trend lines, or candlestick formations. By tailoring the indicator to their crypto portfolio, traders can handle extreme market fluctuations with greater skill. MetaTrader 4, MT4, remains a leading platform for technical analysis and algorithmic trading. Integrating the Stochastics Indicator into MT4 is simple yet powerful for analyzing markets efficiently. This section provides a detailed, user-friendly guide. Add the Stochastics Indicator. Navigate to Insert, Indicators, Oscillators, Stochastic Oscillator. 2. Configure settings. Adjust parameters such as %K periods, %D periods, and slowing factor to match your preferred strategy. 3. Style adjustments. Personalize colors and line thickness for better visualization. Hands-on guidance empowers traders to confidently implement and customize stochastics in MT4, streamlining their trading workflow. Having set up the Stochastics Indicator in MT4, this section walks through live trading scenarios in Forex and cryptocurrency markets. Each example focuses on identifying actionable areas based on crossovers or divergences, confirming signals with supportive tools like trend lines or horizontal support resistance levels, making informed decisions on entries or exits. For instance, a bearish divergence, for example, price making higher highs while stochastics makes lower highs, may highlight diminishing momentum and prompt traders to exit long positions. Real-world examples are vital for learning how to apply theory under real market conditions and are a key skill for technical analysts seeking consistency. While the Stochastics Indicator can be highly effective, improper usage may lead to losses or missed opportunities. Consider these common pitfalls. Ignoring market conditions. Stochastics works best in range-bound markets and should be paired with trend-following tools in trending environments. 2. Over-reliance on one indicator. Avoid acting solely on stochastics crossovers. Confirm signals with other methods, for example, moving averages. 3. Misinterpreting divergences. Not all divergent signals lead to reversals. Analyze price context and overall trend. By proactively addressing these issues, traders can avoid costly errors and refine their strategies for long-term success. The Stochastics Indicator excels when used in conjunction with complementary tools to enhance accuracy and depth in analysis. Popular combinations include **moving averages. Pair stochastics with a 200-period moving average to align momentum signals with broader trends. **Bollinger Bands. Crossovers near Bollinger Band extremes may offer early signals of potential reversals. **Bollinger Bands. Crossovers near Bollinger Band extremes may offer early signals of potential reversals. **Bollinger Bands. Crossovers near Bollinger Band extremes may offer early signals of potential reversals. *RSI, Relative Strength Index. Combining RSI with stochastics is useful to confirm overbought-oversold conditions from two perspectives. This section presents examples where traders combine these tools effectively, emphasizing strategic layering for precision in their market approach. In this video, we explored the fundamentals, applications, and strategies surrounding the Stochastics Indicator. Here's what we've covered. The key components of the stochastics formula, %K and %D. 2. How to apply stochastics in Forex, futures, and cryptocurrency trading. 3. Practical examples of using stochastics on MT4. 4. Tips to avoid common pitfalls and beginner mistakes. 5. Advanced techniques such as pairing stochastics with other indicators. By consistently practicing and refining these skills, you'll build greater confidence and proficiency in your technical analysis, paving the way for better trading outcomes. If you found this video helpful, don't forget to *** subscribe to our channel *** and hit the *** notification bell *** to stay updated on our latest trading tips and tutorials. Education is a continuous journey, and we're here to guide you every step of the way. Happy trading!